Hi, I'm Dongshang. Welcome to Dig Into China, where we explore China in depth to review unique perspectives. China has been heavily promoting AI-related topics lately, with a lot of hype surrounding a company called DeepSeek. At the same time, AI-related stocks and investment themes in China have been surging. Because of this, some people are claiming that China's economy is improving. But is that really the case? Of course not. Right now, China's stock market is completely disconnected from the country's economic fundamentals. The stock market does not reflect the actual state of the economy. So assuming that a short-term rise in AI-related stocks means the economy is recovering is completely incorrect. This is a classic retail investor mindset, focusing only on surface-level trends without looking at the bigger picture. What's more interesting is why China is choosing this particular moment to hype up AI. What's the real purpose behind it? How is this whole thing being orchestrated? These are the questions we should be asking. Let's start by looking at some recent financial data to see how this AI bubble is affecting China's stock market. Recently, Hong Kong's stock market saw an unusual surge led by tech companies. The Hang Seng Tech Index jumped from under 5,000 points a month ago to 5,900 points. At the same time, China's A-shares also saw a corresponding rise. According to the South China Morning Post, this trend suggests that the global capital is shifting back towards China, with money flowing out of the US and India and into the Chinese market. At the center of China's AI investment frenzy is DeepSeek, a company that claims to have developed an AI product comparable to those in the US, but at an extremely low cost. As a result, nearly every Chinese tech stock is riding the wave of this AI hype to cash in. I've already made 2 videos discussing DeepSeek, so I won't go into the technical aspects today. Whether we are talking about copying, imitation, or even legitimate technology transfers, like when a company sells its tech to another company, the core issue is the global spread of technology. And the truth is, technological diffusion is an inevitable trend in modern human society. The world we live in today is essentially an expanded version of the modern Western world. We are not living in some kind of a diverse, multi-ethnic cultural landscape. We are living in a single, dominant cultural framework. I want to quote historian Ian Morris from Stanford University. In his book, The Measure of Civilization, his research team analyzed the historical data and found that no hunter-gatherer society or small farming village has ever modernized on its own. It only happens when they come into contact with a more advanced civilization. No society has ever jumped straight from a nomadic lifestyle to an industrial economy unless it was conquered or absorbed by an agricultural empire. By 1900, Europeans and their overseas colonies had integrated almost the entire world into a single economic system. Globalization had already been developing for centuries. And once a society crosses the fossil fuel threshold, modernization becomes inevitable for the entire world. So what does this have to do with the current AI bubble? There is a saying, go with the trend. In this case, trend refers to objective historical forces, things that happen regardless of individual will. Financial players love to exploit these trends. The global spread of technology is an undeniable reality. As historian Ian Morris pointed out, since the 20th century, Western technology and economic power have inevitably spread across the world. It's like the spread of a fungal infection. Once it starts, it's irreversible. This kind of technological diffusion always moves from the core to the periphery. Only the core regions of the global capitalist system can truly develop original, groundbreaking technology. The United States is the perfect example of a core nation, while China is a classic peripheral nation. AI technology, like so many other modern advancements, was created within Western civilization. Its spread to the rest of the world is unavoidable. Whether it's Wall Street's financial elite or China's comprador capitalists, they are all leveraging this global AI expansion to fuel stock market speculation. The idea that China, a peripheral player, can suddenly leapfrog the core nations is just another marketing ploy. This kind of hype attracts international capital flows. In the short term, this speculation can drive capital from core economies into peripheral markets like China, pushing up asset price in those regions. As long as money is moving and asset prices are rising, financial players achieve their goal. And their goal is simple, either to cash out at a higher price or to offload the Chinese assets they've stuck with. This is the full picture behind China's AI bubble. That's why I keep emphasizing that the key issue here isn't AI itself, but the financial and the political interests behind it. Understanding how capital and power operates is what really matters. Now that we've outlined the bigger picture and the key trends, let's look at the specifics. How exactly is this AI bubble being orchestrated? What is its connection to China's broader economy? And who benefits from this whole scheme? Before we dive in, there is one fundamental point to remember. China's real economy and its financial sector are completely disconnected. I've talked about this before. While China's real economy remains in bad shape, this disconnect creates a major issue, a shortage of valuable assets to invest in. When there is an asset shortage, one thing always happens: artificial hype and aggressive speculation. Right now, China's AI bubble is a textbook example of that. Let's talk about China's asset shortage and the final stage of the AI bubble. The so-called AI boom in China has had a huge impact on the stock market. One key stock driving this hype is DeepSeek, which has become a major tool for speculation. A financial institution in China created a chart tracking AI-related stocks, which clearly shows the ripple effect DeepSeek has had on the market. As you can see, on January 20, 2025, DeepSeek released its new generation reasoning model. About 10 days later, the Chinese stock market started a frenzy around AI stocks, pushing prices up. Many companies have been trying to tie their businesses to DeepSeek, using storytelling and narrative economics to boost their stock prices. According to statistics, 15 major sub-industries and over 150 companies are riding the DeepSeek hype and benefiting directly from this bubble. The chart clearly shows that the companies in computing power, servers, autonomous driving, cybersecurity, large AI models, and even advertising, e-commerce, healthcare, and media have all found ways to brand themselves as a part of DeepSeek's supply chain. This has driven their stock prices higher. In just half a month after early February, the returns for these companies ranged from 20% to 42%. These numbers alone show how big this AI bubble is. One single concept has been able to push up the stock prices of nearly 200 companies, and this number is still growing. What's happening in China's stock market right now reminds me of previous waves of speculation. Over the years, we've seen similar hype cycles, whether it was multi and the liquor industry, the military sector, especially aerospace, semiconductors, or the so-called new energy sector, including China's electric vehicle industry. Now the focus has shifted to AI. But just like before, I don't think this time will be any different. These speculative waves come and go, but they don't fundamentally change the direction of China's stock market. They create short-term excitement but fail to bring lasting growth. The reason why these bubbles don't create a real impact is that China's stock market and even its economy is like a stagnant pool of water. No matter how many new themes emerge, the fundamental issues remain unresolved. Even AI won't be able to fix them. I break these fundamental problems down into three key areas. First, confidence in China's economy has completely collapsed. Consumer confidence is at all-time low. Broad money supply growth is slowing and foreign investment has plunged off a cliff. Second, China is experiencing deflation. A key indicator of this is the GDP deflator, which has been declining for several consecutive quarters. Bloomberg reported on this issue back in 2024, predicting that the deflation would continue into 2025. The GDP deflator reflects the real movement of price levels by measuring the ratio between nominal and the real GDP. The effects of deflation are clear. Weak consumer demand and a massive inventory buildup that companies can't clear, forcing them to cut prices. Right now in China, aside from essential goods with rigid prices, many products are being sold at discounts. This is a direct sign of deflation, which, to put it simply, means economic depression. Third, the collapse of real estate and the sluggish stock market. Real estate used to be China's most valuable sector, but those days are over. If we look at China's real estate development indexes, it's at its lowest level in a decade. At the same time, stock market returns have been poor, especially after US-China trade decoupling. Chinese stocks are now seen as toxic assets dumped by foreign investors on a large scale. With both the stock and housing markets in decline, financial investments in China have become increasingly unattractive. Looking at these three factors, isn't it clear that AI won't solve China's economic problems? Consumer confidence has collapsed, unemployment is rising, deflation is worsening, and both the stock and the real estate markets are in free fall. AI can't do anything about these fundamental issues. That's why China is facing an asset shortage. In a country this big, there are no good investment opportunities, just low-quality assets everywhere. Since there are no real high-quality assets to invest in, the only option left is to create the illusion of one through hype and deception. Right now, the so-called high-quality asset being hyped up is DeepSeek. As I mentioned earlier, China's financial middlemen are fueling the AI investment frenzy purely out of self-interest. But one hand alone can't make a sound. Financial institutions need partners to amplify the hype and make it work. Those partners are Chinese companies, both state-owned and private. The main reason for this is simple: profit pressure. With China stuck in deflation, market demand is weak. If companies continue to invest and produce as usual, there is a high chance their products won't sell. And even if they do, they will be selling at a loss. So how can they make a profit? At times like this, companies have no choice but to shift their money from production into non-productive sectors, especially finance. This is why in economic data we see a significant rise in corporate investments unrelated to actual business operations. A large chunk of this money is flowing into AI-related financial assets, which have a higher chance of increasing in value. This allows companies to profit even while the real economy is struggling. In other words, financial speculation is the result of corporate profit pressure. And when financial institutions and businesses team up to inflate a bubble, the most direct consequences is capital misallocation. Instead of investing in real production, a massive amount of corporate funds are being diverted into speculative activities. If this continues, China's economy will become even more hollow and bubble-driven. It will collapse faster and more completely. But no matter how aggressively financial institutions and corporations push this hype, China's AI bubble won't last long. It will eventually burst. So when will that happen? One key moment will be when the US takes countermeasures that will signal the countdown to the bubble's collapse. Bloomberg has already pointed this out. US-China decoupling is bound to accelerate. And if Trump returns to power, restrictions on China's AI technology and trade will only increase. China's so-called independent AI development may sound impressive, but in reality, it still depends on American chips. If the US imposes an embargo on those chips, China's AI industry will be crippled. Beyond the hardware, China also relies on American AI models for simulation and training. If the US blocks access to these tools, China's AI development will come to a sudden halt. As I mentioned before, technology spreads from the center to the periphery. But the moment the center cuts off contact, the periphery will stagnate. When that happens, capital and the technology will flow back to the center, leaving the periphery to decay. That's exactly how China's AI bubble will burst. And when will this happen? It could happen at any time. This year is 2025, a crucial year. If you look back at the stock market history, you will notice a pattern. Every 10 years, something goes wrong. Sometimes it's 9 years, sometimes 11, but there is always a financial crisis around this cycle. Let's check the timeline. In 1997, Hong Kong experienced a stock market crash. Exactly 10 years later, in 2007, the subprime mortgage crisis hit. 9 years after that, in 2016, China suffered a major stock market crash and a massive capital flight. Now, 9 or 10 years later, 2025 or 2026, there is a high probability that either China or Hong Kong will face another stock market disaster. Which year will it be? I think 2025 is the likelier one. The US is ready to act at any moment, imposing sanctions and further decoupling from China's semiconductor and AI industries. National security agencies will crack down hard on AI-related smuggling, technology theft, and illegal transfers. The US is moving quickly. All signs suggest that this AI bubble will rise fast and burst just as quickly, just like all of China's previous bubbles. Nothing fundamental has changed. The Chinese economy is still on its predetermined path. China's stock market has a predictable pattern. Short-lived bull runs followed by prolonged bear markets. A bull market never lasts more than a quarter, while the bear market drags on for a decade. That's the cycle. This isn't a normal stock market, it's a scam market. But to be honest, I think Chinese investors and the Chinese people in general are easy to deceive. Their collective memory is incredibly short. Even if they experience a financial disaster just 3 months ago, they'll forget about it completely. Even when it directly affects their lives and finances, they'll still erase it from their memory. So from that perspective, everything I'm saying today about bubbles and scams will likely be forgotten soon enough. It's a sad reality. Thank you so much for watching. If you find this video helpful, please like it, drop a comment below, and hit the subscribe button right here. It really helps YouTube suggest my video to others. I'll be back with more content soon. Until then, be well.